Hello class and welcome to our 13th lecture series on financial accounting or principles of accounting. I'm your instructor, Dr. Jamal. So we were talking about how we account for plant assets, and today we'll talk about in our previous class, if we just recap, we talked about what is depreciation, how we are going to account for it, and then we talk about the methods to calculate the depreciation. The first one is straight line method. Second one, we talked about the unit of production method, and then we talked about the double declining method or the accelerated depreciation method. And then we talk about their relationship, what are the tax implications for accelerated depreciation. We do have tax savings. Why? Because in early years, we have more depreciation. So our profit will be lower, our tax will be lower. Because depreciation is non-cash expense, so we can save that. So we can save that cash, we can save it with the bank, earn some interest. So we call this tax shield or tax savings. Okay, now our next learning objective is what happened if one of the variables changes. We talked about capital expense and the normal expense. What if we change the engine of the truck? Previously, it will last for 5 years. And now, after changing the engine overhaul, it can last to 8 years. Now, what happened to the depreciation? So its life increased. So we have divided our depreciation with number of years 5, but now the number of years has changed. So it means there is a change in years. Right? So we'll plus what if we want to calculate per month depreciation, because the formula is going to leave us annual depreciation, partial year. So let's talk about that. We'll talk about this kind of stuff. Sorry. Here we go. So let's do the example here. So companies must compute depreciation for partial years. Why? Because each method gonna give us annual depreciation, whole year depreciation. So if we want to calculate partial year, between for 1 month, 2 months, 3 months, then we need to divide accordingly. So let's talk about this. Suppose UPS purchases a warehouse building on April 1st. So be very careful, very attentive to the dates here. So April 1st, for 500,000, the building's estimated life is 20 years. And its estimated residual value or scrap value is 80,000. UPS accounting year ends on 31st of December. So compute the UPS depreciation for April through December. Through April to December, how many months are there? April, May, June, July, August, September, October, November, December. 9 months, right? But if we apply for straight line method, what would be the depreciation? So full year depreciation gonna be cost minus salvage value or residual value divided by life, right? Answer gonna be 21,000. So this 21,000 is for whole year from January to December. But we want to calculate from April to December. So we just multiply 21,000 multiplied by how many months? 9 months. And how many months are in a year? 12. So 9 by 12. Answer gonna be 15,750. So everyone understand that? Let me ask. Ella, you got the?
Yeah, I got it.
Dunjun Kim, Pinyo, Nam, Marilyn, Anthony?
Yeah. Got it.
Good. Now, what if we change the useful life? I told you, what if there's a major engine overhaul, or we expense as, to increase the life of an asset, we treated it as capital expense. So what happens if we apply capital expense and the life of the asset increases? So after an asset in its use, managers may change its useful life or residual value on the basis of experience and new information. Well, nowadays, the prices of steel, iron are rising. So we bought a plant 5 years ago, and now its scrap value increases because price of steel or price of iron increases. So is there any change in depreciation? Of course, yes, because the variables changes. So accounted for the period of the change in the future period, okay, prior year are not adjusted for a change in estimates. Okay. So the accounting law, it states that what happened in the past stays in the past. Right? So we don't have to change the past. Why? Because we already calculated the profits, we already submitted our documents to the government department, to our website, to our Security and Exchange Commission. So what happened in the past? Oh, sorry. What happened in the past will stay in the past. So we don't have to. So we do not have to go back to previous years and try to change that. Why? Because it's already published. We cannot change that. So from now on, there are going to be new depreciation because estimates has been changed. So we call this calculating a new depreciation based on change in estimates. So let's see that. So we have illustration here. So let's solve it together. So what happened here? So we have Arcadia HS purchased equipment for 510,000. Which was estimated to have a full useful life of 10 years with the residual value of 10,000 at the end of the time. So depreciation has been recorded for 7 years on straight line method. So we already have used this equipment for 7 years, right? On the basis of straight line method. So what happened now in 2014, which is a year 8, it is determined that the total estimated life should be 15 years with the residual value of 5,000. So previously residual value was 10,000 and now we have decreased the residual value and increased the life, right? Now, number 1, what is the journal entry to correct the prior year depreciation? Calculate the depreciation expense for 2014. So the prior years are not adjusted. We can calculate, but we will not record in previous years. So let's see that. Number first, because there is no entry required for prior years. What happened in the past will stay in the past, right? So from now on, what will happen? The number of life has been increased. Previously, its life was 7 years and now 15 years, right? Its residual value is 5,000. So what will happen here? So you see, what will happen at the end of 7 years? 7 years, first of all, the annual depreciation on the basis of straight line method is, so we have 510 minus 10,000 divided by 7. Answer gonna be And 10 years, oh, sorry, not 7, 10 years, sorry. My mistake, here 10 years. This life is 10 years, sorry. So which means 50K per year. How many years has passed? 7 years has passed. Right, 7 years has passed. So multiply by 7, answer gonna be 350K, 350,000. So what is the value? 510. 350,000 K worth we already have used. So how much left? So 510 minus 350K, which means this much worth of the equipment left. And now this is the new book value at the start of 8th year, right? It means 7 depreciation we already have recorded. So book value gonna be original cost minus the accumulated depreciation, which is 350,000 here, right? Now we have increased the life from 10 to 15 years, right? So from now on, we are staying at year 8. So we start from 0. So we make a line here. So let me go to other. We are here at the time, this is at the start of 8, 9, 10, 15. So we are here sorry guys, it was a glitch. Okay, here. So we are going to make a timeline because we are at the start of 8th year. So you write it down above the position here. So we are here at the 8th year, and then you just draw till the end, 15. So how many intervals, how many time periods, how many years are here? So you are at the start of 8, so it's 1, 2, 3, and then till 8, right? So that's why your new cost gonna be 160,000. Your residual value question mentioned decreases to 5,000 and divided by number of year 8, right? If you divide it, your depreciation gonna be 19,375. Rest of the, entry is the same. Depreciation expense to accumulated depreciation, that's it. This will go to income statement and this will go to balance sheet. Okay. Guys, can you hear me?
Yes, now I can. But on this slide, I could barely hear anything.
Okay. So you understand this slide, or should I repeat one more time?
Could you please? Yeah.
Okay, sure. Okay, let me erase all this. So up till here, previous slide, you understand how we got the idea of 160,000?
Yes.
Okay. Now we want to calculate the straight line depreciation. For straight line depreciation, how many variables we need? We need cost, we need scrap value or residual value,